My name is Chad Hart. I'm an extension economist at Iowa State University. And here that we've reached the middle of July, USDA has updated their World Ag Supply and Demand Estimates report. And it's our big report that sort of updates us both on corn and soybeans, not only the crop that's growing out in the field right now, but how we're going to utilize that crop over the next 18 months. So let me share with you what USDA found as they updated their numbers this year. Now, in this case, the WASDE report, as is known, came out on July 12th. And what we saw was let's call it a dramatic shift in the crop pricing over, during the time. Right after the report, both corn and soybean prices were down significantly. The day after the report, we saw a tremendous rebound in prices. And I think that's because the market is, if you will, dealing with the uncertainty of not only what's happening with the crop as it's growing because of the problems with the drought, but also looking at the issues we are having with demand, and especially looking at international sales, because the high prices that we've had has had a significant erosion impact in terms of our ability in the export markets. Now, looking at the data that USDA has, here's where we're at right now. So in this case, USDA updated this entire table. The acreage numbers come from the June acreage report, which was released at the end of the June, but the other numbers were updated here in the middle of July. What they found for corn was, as they looked there, is that from the acreage perspective, we added 2.1 million acres that we didn't expect back in March, April, and May. So that was adding to possible corn production. But as they looked at the yield potential for this year's crop, they lowered that by 4 bushels per acre to 177.5 as we look out there. And so that's bringing production back down a little bit. Net, though, when you compare where USDA was at with the June WASDE report versus this one in July, they're only up 55 million bushels in terms of that overall expected production. Now, in this case, that's still looking at the potential of a record crop. For comparison, look back at the 2021 column here, and that's the previous record as we're standing there. So we are still staring at large potential supplies coming down the line. Which brings me down to the gray box. The gray box in this table is the demand sector as we look there. And we saw USDA make several adjustments here. Not only looking forward for the 2023 crop, but looking back at how we've used the 2022 crop thus far. And what they ended up doing for 2022 was basically raising the feed and residual number up by 150 million bushels. Then they turned around and lowered the ethanol number by 25 million bushels and lowering the export number by 75. And so, in the grand scheme of things, they did show that we are using more corn than we expected, but it's coming from the feed sector or the residual side. We actually lost some ground when it came to biofuels and that international demand that looms out there so large. Now, as we look forward to 2023, they really didn't make any adjustments on demand there, but I think the concern is here is that the 2022 shifts may indicate some problems as we look out for 2023. Come down to the bottom line, though, USDA was able to maintain their price projection for the 2023 crop at $4.80 a bushel. Now, when it came to the soybean market, the idea is what we saw there was some similar movements, but there were some significant differences here as well. Let me start with the supply side. In this case, the acreage adjustment down 4 million acres. So where corn gained land, soybeans lost that. But on the other hand, USDA also didn't adjust yields as we're looking forward here. So they held at their trend line yield of 52 bushels per acre. What that meant was production actually came down 210 million bushels. So this crop did tighten up. Earlier, USDA had been projecting the potential for a record soybean crop. Now we're talking about a crop that is still large, but it won't be the record levels. And again, compare back to 2021, because that would be the largest crop we've ever had. So we're below that and much closer to production levels that we saw just last year. But as we look at the demand side, we saw some of those same downward adjustments that we saw on the corn side. It's just that they extended them into 2023 already here. And so they ended up reducing a little bit on crush demand, but the big cut was in export demand as we're looking there. In fact, as you'll look, you'll notice that they're projecting 4 years of, if you will, decline, starting back in 2020, where we reached our peak in terms of the number of bushels moving through the export markets. We've been down each year ever since, and they expect that to continue as we look forward into 2023. But the soybean market remains tight, and that is helping support soybean prices. And I think that was especially why the market reacted strongly and positively the day after these reports, because when you do look at ending stocks floating in that 250 to 300 million bushel range, that goes to show there's not a lot of excess supply available if we do get some pickup, especially in our export demand. So as we're looking out there to that season average price, USDA actually increased that for the 2023 crop by 30 cents up to $12.40. So like I say, the market has sort of been swinging significantly on this. The day of the report, the big concerns were about the cuts we saw in terms of the demand sector, and prices went down. The day after, there was much more concern about, hey, we've got these tight stocks as we're looking here, and we still have problems when we're looking at the crop as it's growing out in the fields. In fact, as we look at the crop condition ratings that come from the weekly crop progress reports, what we found is that over the last couple of weeks, these rains that have been moving through have been in helping the crop bounce back and improve some, but we're still talking about a crop that is rated a little bit below average in terms of what we expect to see at this time. In this case, the black line you're seeing here shows you sort of the 5-year average, what we see in those good to excellent ratings when we look at the national crop. And typically about this time of year, we've got roughly 68, 69% of the crop is rated good to excellent. As we sit here today, basically in the middle of July, you can see the red line is indicating we're down around 60% of the nation's crop is rated that way. So it is a little bit below average, and that is what, again, raises some concerns about, will we need to see USDA adjust that yield down again, especially if we do continue to see the drought conditions extend themselves throughout the entire corn belt. And that's true whether we're looking at corn or soybeans, because we see that same sort of tale here where this crop is slowly improving in terms of this rating, but it's still well below average. And so that is the key piece when we're looking at the supply side. When we're looking at demand, we can also look at the tracking of weekly advanced sales for the crop that we're growing right now. So in this case, this is looking at export sales to countries around the world for the crop that is still growing out in the field. So these are purchases that won't be delivered on until this fall. And again, the black line represents our 5-year average. In this case, the green and blue line shows you what happened over the past couple of years. And the red line shows us where are we at so far this year. And as you can see, soybean sales roughly half of what they are on average, and definitely below what we saw for 2022, which was one of our best starts to the export year, even though in the end it turned out to be a slower year than what we had seen in 2020 or 2021. Now, when it comes to the corn side of the equation, similar sort of thing there. We're seeing about half the sales we normally have at this time. Again, really trailing in this case 2021, where we saw a big surge in sales, mainly to China, that was being driven by the phase 1 trade deal back there 2 years ago. And so as we're looking at corn and soybeans, like I say, it's the international marketplace where we've tended to struggle the most here right now. And it does bring up that concern that as USDA has lowered the supply side, they're also lowering the demand side of the balance sheet to sort of match, because of concerns about our international competitiveness right now. It is not an issue with the dollar itself or the value of the dollar, but it's just more the high prices that we have here within the US don't translate well within the international market right now. So the futures market is sort of, if you will, in two different spots at once. As we look at finishing out the old crop, the 2022 crop, we still maintain some very strong prices. As you look at July futures up there, floating near that $6 range. On the other hand, as we look at new crop futures, we're down here in the $5 range, so about a dollar discount there because of the concern about the possibility of these bigger crops and the lack of strong international demand. Now, as we look all the way out towards next year's crop, 2024, you can see that the markets is sort of signaling that, hey, where we're at this year may be a spot that we're going to settle into here for a while. Now, on the soybean side, we do see a little bit different pattern here. It's still, again, strong as we look at old crop sales there. Drops down about a dollar for new crop for 2023, but you'll notice there's another drop down the line here in 2024. The market, I would say, for soybeans is a little stronger as I look at 2023 because of the additional tightness within the soybean market. The idea is those ending stocks are really tight. And even if demand is weakening a bit here, it's still going to be tight as we finish out the 2023 cropping year. So they're looking for the possibility, I would say, of additional expansion in production as we move forward to 2024. That being said, though, I would say farmers are staring at the possibility here in 2023 where, while the economics may be weaker than what we've just experienced over the past, especially 2 years, we're still sitting in a fairly decent spot, especially on the soybean side, in terms of finding some profit margins out there to be gathered here. When we looked at production costs on the soybean side, we're talking about the $12 range is where we started at this year. Whereas if I take you back to corn, we're right around that break even point because we estimated roughly $5 per bushel production cost here. So where we had some healthy profit margins, still do for the 2022 crop, things are much more, more likely that prices will match the cost that we face here for the 2023 crop. But anytime you can find a few pennies of profit in the ag markets, that's usually a pretty good day on it as we look over the long run. Well, anyway, that gives you a sense of where we're at with the markets right now. The idea is we want to try to give you these updates whenever USDA provides us those big reports like the WASDE report. And so we want to thank you for spending a few minutes with us looking over what's happening in the crop markets. We'll have another update here, likely in the middle of August, as we get the next big update, and that will include probably some data that indicates just, if you will, stronger indication of what yields will look like as we go into the harvest season. With that, my name is Chad Hart. I'm an extension economist with Iowa State University. Thank you for your time.